Let's talk about tax breaks for a single parent. So if you're a single parent, you're listening to me right now, I'm going to share with you a few hacks that will help you reduce your overall tax liability. The first thing is you need to determine where the child lives. This is important. And when we talk about determining this geography, basically, usually the parents who has custody of the child claims the child on his or her tax return. However, there may be an exception. So where the child spends the majority of his or her time can be a factor as to which parent can claim the child on their tax return. Because so the IRS will pay attention a lot to that. So the IRS can actually disregard the divorce decree or separation agreement when it comes to custody. Okay, so you have a segregation of processes here between taxes and law in that sense. So when a child lives with one parent for more than half of the year, even if it's not the custodial parents, the IRS is likely to grant their parents the right to claim the child on the tax return. And the IRS considers where the child sleeps as a strong determining factor, okay? And the thing is that many parents do not know that the head of household filing status exists and instead select single as their filing status. So basically what you want to do is the head of household status has many tax benefits, including a higher standard deduction amount. So filing as a head of a household also reduces a single parent's taxable income. To qualify as a head of household, you must actually pay more than 50% of the household expenses. You must be unmarried as of the last day of the tax year, and you must have your child live with you for more than 6 months of the year, not including the time the child spends at school. Okay, so it's really important to have a clear idea about that. So it's one of those things where you want to be in a situation where you got to be clear as to where the child lives and sleeps. Okay, you also need to know who claims the child credit. So single filers who make less than 75 grand a year, 150 grand for married filers, and 112,500 for heads of households might be eligible for the child tax credit. So for the parent to qualify for the child tax credit, the child must have been under 17 years old at the end of the tax year, and the child's residence and citizenship are also taken into consideration, as he or she must be a U.S. citizen, a U.S. national, or a U.S. resident alien. So this is kind of important. The second thing is you need to actually file as head of household. I just spoke about that. That will really help you out, okay? So you are able to minimize your taxes. So first, determine where the child lives. Second, you want to file as head of household. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. The third thing you want to do here is to establish qualifying dependents, okay? So when we talk about qualifying dependents, what is that? There are conditions that determine if you actually can claim the child as a dependent. It's one of those things where the IRS has been consistent over the years, okay? So the IRS uses the custodial residency test in most cases to determine if you can claim your child as a dependent. However, if there's a non-custodial parent, they can be granted the right to claim your child as a dependent if all of these conditions apply. So those 4 conditions must all simultaneously apply. So you and your child's other parents, whether married or not, lived apart for the last 6 months or are legally divorced or separated. The child received at least half of his or her support from the parents for at least half of the year. You and or the child's other parents have legal custody of him or her, and either you provide a written waiver to not claim the child as your dependent, or a pre-1984 legal agreement exists that allows the non-custodial parents to claim the child as a dependent. The next thing you want to do is you want to deduct child care expenses. So if basically your dependent child is 12 years old or younger and you pay for daycare while you work or look for work, you may be eligible for the child and dependent care credit. Now to qualify, you need to have earned income, be a full-time student, or be physically or mentally unable to care for yourself. And the care provider has to be at least 19 years of age if also your child can be a parent of the qualifying child rather, or you have to identify them on your tax return. So depending on your income, the credit can be up to 35% of child care costs. This is kind of cool. I mean, when you think about it, 35%, that's so good. And any contributions to child care expenses from an employer need to be deducted from the total expense. So it's really cool. So when we talk about that's kind of important in terms of, you can also claim the child tax credit. So you just make sure that you actually, if you make sure that you deduct as much as possible as legally allowed under the law. Boss, I want to quickly remind you of today's topic. I'm giving you tax tips for single parents. Next thing you want to do here is to include the dependent care credit. So the IRS allows single parents to claim a percentage of child care expenses paid that allow them to work outside the U.S. or look for work. I mean, outside not the U.S., outside the home. But the thing is that one thing I want to say here is that it's important to understand that you actually have an amount that is capped. Okay. So for this year, for instance, the amount allowed is up to $3,000 for one child and $6,000 for two or more children. So when you have 3 or 4 or 5, the amount is still $6,000. So we're talking here about the child and dependent care credit. Okay. And so one thing I want to say here is that basically for this year, when we talk about your like child care expenses, the amount of qualifying expenses will actually from one person to another will depend also upon your situation. Okay. Now, the percentage of qualifying expenses eligible to the credit actually increases from 35% to 50% under certain circumstances. And one thing I want to say here is that you have to understand that like 2 or 3 years ago during COVID, the IRS temporarily increased the amounts. Now they brought it back to the pre-COVID sort of amounts. Okay. So in either case, make sure that you are actually documenting all the expenses, because the IRS is pretty adamant at making sure that people do not sort of abuse the system. So if you are a single parent right now and you actually, you take care of your child and everything else, you want to actually have proof, especially for large amounts. I mean, everyday expenses, not a problem, but for large amounts that are really out of the ordinary, you want to have proof, because, you might be audited, and the last thing you want to have is to have a situation where the IRS is asking you to prove something. You actually spent the money and you can't prove it. So this is a bummer, because the IRS will just think that you are actually just not telling the truth on your tax returns, and they might actually penalize you, and you do not want to have that. So you always want to be in a situation where you can actually prove amounts, especially large amounts. Okay, so keep your receipts, and if possible, try to really charge everything on a credit card or debit card. That way you have electronic evidence of the expense. The next thing you want to do here, you want to understand how the IRS treats child support and alimony. So child support is not taxable income. And if a parent actually paid child support, those payments are not considered deductible. So if your divorce or separation agreement was executed after December 31st, 2018, alimony payments are not deductible for the spouse who makes the payments, and they will be not included in the income of the receiving spouse. If the divorce or separation agreement was executed on or before December 31st, 2018, the opposite applies. Next, you want to claim tax benefits for education. So you want to take advantage of as many tax credits and tax deductions as possible. Single parents need to be aware of everything for which they are eligible. So the thing is that here is what you need to know about claiming education credit. So you have the American Opportunity Tax Credit and the Lifetime Learning Credit help actually defray the cost of post-secondary education. And so qualifying single parents who are paying for college or other post-secondary education for their children might actually be able to claim those credits. And the American Opportunity Tax Credits offers a maximum annual credit of $2,500 per student. The Lifetime Learning Credit offers a refund up to $2,000 per tax return. So you have $2,500 and $2,000. So in addition to other rules specific to each credit, 3 basic criteria must be met in order to qualify for this education credits. Number 1, the parents, the dependent, the dependent or a third party must pay qualified education expenses for higher education. An eligible student must be enrolled at an eligible educational institution. So I want you to pay attention to the word eligible here. And the eligible student must be a dependent listed on the filer's tax return. So a couple of options are available as tax breaks for parents saving for their children's futures. Okay, so a single parent planning to pay for college in the future can start saving now using an education savings account or a 529 plan. Both provide tax-related advantages. So an education savings account, this is what we call the Coverdell. Not what we call, that's what the authorities call Coverdell ESA. Okay. And so this is kind of cool. And qualified tuition plan, also known as 529 plans, vary from state to state, but the main tax advantage is the same. The earnings are exempt from federal tax when used for qualified education expenses of the designated beneficiary. And this is kind of cool. By the way, boss, welcome back. Now, welcome back. I want to quickly remind you, of today's topic. We are having a conversation about tax tips for single parents. Next, you want to determine your eligibility for the Earned Income Tax Credit. Now, some parents qualify for the Earned Income Tax Credit, and parents with earned income below certain levels can earn credits ranging from $3,733, so $3,733 to $6,935, depending on their filing status and number of children. Also, you want to deduct adoption expenses. So this is another big one. So a parent who adopt a child can claim a non-refundable adoption credit for the fees, legal costs, and travel expenses associated with the legal adoption. In addition, adoptive parents don't actually have to pay tax on income they get from adoption assistance provided by their employers. Now, it's one of those things where, again, going back to what I said about the need to document every receipt, everything that you actually spend money on. You need to be able to substantiate that. And it's one of those things where the IRS really has some kind of they have benchmarks, and so they know, like, based on your zip code, what kind of expenses you, like a normal parents will spend, what kind of expenses the normal parents will have when it comes to adoption, because you bet you're not the only one who has adopted a child in that area in the last 50 years. So the IRS has records of everything. So they will compare and contrast what the amount you are showing to them for tax for adoption expenses versus the amount they have in their records. So as long as the delta is not really that big, you are good to go. But if the delta really seems to be like huge, then you are going to have to substantiate that. For example, if in your area, in your zip code, people spend, like, parents are usually spending 10 grand for child adoption expenses. If you actually claim on your tax return that you actually have spent $50,000, the delta is really big. Okay, from 10 grand to 50 grand, you're gonna have to justify to the IRS what's really causing that sort of surge. You want to take advantage of the free tax return preparation if you qualify. So when taking on taxes as a single parent, the complex IRS rules can be confusing, but you deserve to maximize your savings and possibly get some money back. This is something that you can really do. Now, it's just better to seek the advice of a tax professional, because this will ensure that you file accurately and receive all of the tax credits you qualify for. So if you make $60,000 or less, have a disability, or speak limited English, you'll likely qualify for the IRS's Volunteer Income Tax Assistance Program, the VITA, and which connects you with a certified volunteer to provide you with free basic income tax return preparation assistance. So to locate the nearest VITA site, you want to go to the VITA locator tool on the IRS website, or you can call right now 1-800-906-9887. So this is kind of cool. Now, before going, you want to read publication 3676B to see what services are provided, and you want to check the IRS's what to bring page to make sure that you have all the required documentations and information needed. Okay, so this is really cool. Now, this is really a great resource, though. I mean, if you qualify, you're gonna love it, because it's one of those things where you are basically going to have a certified volunteer prepare for you. Actually, like, they will prepare for you your taxes. They will actually will take a look at your wages, salaries, like your W-2s. They'll look at your Form 1099 INT, that's your interest income. They will look at your dividends received, Form 1099 DIV, your state tax return, Form 1099G. You also, the unemployment, the benefits. You can see on the screen what I'm reading here, so you have a clear idea. The thing is that it's better that you go there with those documents. So basically, I want you to look on the screen here. So the VITA volunteer will prepare wages, interest income, dividends received, state tax refunds, unemployment benefits, IRA distributions, pension income forms, okay, Social Security benefits, simple capital gain or loss, and sale of your home. Now, when things become a little complicated or things have become a little convoluted, the volunteer will not do it. So you're going to have to pay someone to actually do it for you. So here, like a VADA volunteer will not prepare, like, for instance, Schedule C with loss, depreciation, or business use of your home. A complicated Schedule D. So we're talking about capital gains and losses. That's why earlier I said it has to be a simple capital gain or loss Form 1099-B limited. Okay. And also, and other things that the VADA volunteer will not do. You can see on the screen here what he or she will not do for you. Let me give you a few pro tips before I actually close to this conversation. We're still having a conversation about tax tips for single parents. Now, when both parents claim the same child, then we have a situation, right? A situation. So it's one of those things where you got to really find solutions internally. So divorced parents should communicate clearly in advance of tax season to establish who will claim the child or children. So in the event of a dispute where the child's overnights are split evenly between the parents, the IRS will award the dependent deduction to the parents with a higher AGI, adjusted gross income. So when both parents claim a child or on an electronically filed tax return, the second return will be rejected, the one filed later, as the child's Social Security number will have already been used on a return. If, however, you believe you have the right to claim the child, according to the dependent's tax rules, you can dispute this. This is totally possible. You just need to file a dispute with the IRS, not a problem, okay? And so here are the steps you need to really take. You want to file a paper return instead of e-filing it. That way, basically, you're not going to be rejected based on the electronic checks that the IRS has when it comes to the child Social Security number. And so you can actually continue to prepare it online, but you will need to print it and mail it instead at the end. Number 2, you want to include a letter explaining the situation along with evidence like school registration and medical records, proving that you have the right to claim the dependents. So the IRS will actually review both returns, contact both of you by mail for further proof if necessary, and then decide which person can claim the dependents based on current tax law. And so this is one of those things. Now, the bottom line here is that, it's just a lot better to always talk to an attorney, a tax attorney, or a CPA, or even an enrolled agent if your tax situation is a little convoluted, and if you need some kind of clarification. Now, our team members are always here to answer any questions you might have. Not a problem. So don't hesitate to contact us. Just put below in the comment section. Ask your question, and we'll certainly get back to you. But please, when you ask your question, let us know the city and state you are actually commenting from, so we have a clear idea how your state tax income situation might actually shape up too. So that when we answer you for the federal level of things, we can also answer you simultaneously what will happen at the state level as well. Thank you so much for your attention. I really appreciate it. In today's conversation, I was giving you tax tips for single parents. So I spoke to you about, let's do a quick recap here. So determine where the child lives, file as head of household, establish qualifying dependents, deduct child care expenses, include the dependent care credit, understand how the IRS treats child support and alimony, claim the tax benefits for education, determine your eligibility for the earned income taxes, deduct adoption expenses, and take advantage of free tax return preparation if you qualify. And then I give you a few pro tips. Thank you so much. God bless you. I'll speak to you another time. Until then, remember, stay marvelous.